Okay, good afternoon, everybody. My name is Ellen Friedman. I'm a project finance partner at Nixon Peabody in New York City. Very excited to have this panel and to have the great panelists that we have, as well as all the participants. There's obviously a lot of interest in carbon capture and 45Q tax credits, and we're going to dive into some of the specific risks and some of the solutions that we see from the insurance side that might be able to mitigate some of those risks. So just briefly, the agenda that we are proposing for today will include first a brief background into the current state of the 45Q tax credit and CCS projects in general. Then we'll go and have an introduction by all of our speakers. And then finally, we will try to dive into some of the risks, identifying them, and then finally talk about tax insurance, among other types of insurance, and try to figure out how they might mitigate some of these risks in the CCS 45Q project. So back in 2018, Congress passed a law which updated Section 45Q under the tax code, which addressed a lot of the concerns that were there with the original formulation of the statute. It eliminated a cap that applied, increased the credit levels to higher dollar numbers per metric ton of carbon that would be sequestered. It expanded coverage to include direct air capture and commercial utilization of carbon. It also expanded the benefits of the credit for carbon oxide in addition to carbon dioxide. The credit is a 12-year production type credit, which is based on tonnage that is sequestered over the 12-year credit period beginning on the date the project goes into commercial operation. And it provides certain ways that the original projects, if any, might also that had been in existence prior to February 2018 to benefit from the new provisions of this code section. One of the requirements currently in place is that the projects have to have begun construction prior to 2024, and there are certain minimum emissions and capture thresholds that must be satisfied during each year of the 12-year period in order to benefit from credits for that particular year. The IRS issued guidance in February of this year that addressed beginning construction, providing for a 6-year continuity safe harbor. It also has clarified what the beginning construction criteria mean in the context of a CCUS project. It importantly provides for a 50-50 pay-go structure, which we will talk about later in the context of structures. It provides a certain safe harbor for partnership flips, which is similar to some of the safe harbor in the wind industry that really accelerated tax credit investment into the renewable space in general. What it did not provide for, at least not in the eyes of some of the tax investors, is absolute clarity on the economic substance point, which we will talk about as well, which is an important, it's important for a lot of these CCS projects, given that, that the cash flow that might be generated from their operation is in some cases solely as a result of the monetization of the credit. Finally, in May, there's a set of proposed regs that address a lot of important features of the credit, including recapture mechanics, contractual assurance for injection, disposal, and utilization, what those contracts need to look like, certain approved protocols for MRV, or monitoring, reporting, and verification, for different types of sequestration, details as to how to apply for the claim and how to transfer, the credit to off-takers, and certain rules about retrofitting existing CCUS equipment under what's called the 80-20 rule. Looking forward, there are some bills in Congress, that would extend the deadline from 2024 forward. There's also been talk of refundable credit. And then, we are looking at a presidential election this year, and, there might be, down the road, a possible legislation that would address or would price carbon into on a federal level, which would certainly add a bit of a stick to what I think is the Section 45Q carrot in the carbon discussion. I do point out that there's a comment period with respect to the May 45Q proposed regulations that is due to end in the next several days, I think around the 28th of this month. And, if there's anything that as the audience wants to or thinks, might be tweaked in those regulations, reach out to us, or, feel free to make those comments, because I think that, as an industry, this is, it's really important that the ground rules are clear and people are able to execute without friction from, ambiguity in the regulations. Finally, just unlike what I see as a general matter in the renewable space, where wind and solar are kind of very specific types of projects with, generally speaking, similar technology, what I think becomes challenging in CCS is the vast variation of types of projects that might come up. And, just as a general sampling, we see different technologies. Some are amine-based capture facilities that could cost $1 billion or more that are going to be installed along fossil power plants. There are direct air capture units that are being proposed to be built in, for example, Western Texas, where there are EOR wells. There's proposed projects working with ethanol producers or other manufacturers, or biorefineries, where there's a relatively concentrated carbon stream. And then, in some cases, there are existing CCUS projects that may not have previously obtained any credits, and now they're looking to take advantage of this updated 45Q. All of these projects are going to require significant investment, tax credit investment, debt, and equity investment. They'll all need to address and come up with some innovative financial structures, taking into account, among other things, the 50-50 pay-go structure. They're all going to have to address negotiations between the emitters and the CCUS owners. In some cases, there might be common ownership, but not necessarily in all. And, those contracts are going to be somewhat challenging to execute on. On the offtake side, the current proposed regulations actually provide some guidance as to what needs to be in these offtake contracts. But again, there's going to be interesting conversations and negotiations ahead for those. And then finally, just progress is being made, but it's slow in terms of characterizing additional sites that might support Class 6 wells where there is no EOR component, as well as developing innovative utilization for carbon, such as making super strong concrete and other types of utilization where you can demonstrate long-term capture that satisfies the statutory requirements. So there are common features, to the extent they're all going to take advantage of 45Q, that they're going to all have common concerns about recapture, et cetera. So we are going to use the opportunity today to talk to the panelists about the insurance space and how that sector can support and de-risk CCS and 45Q structures going forward. So I am delighted to introduce our panelists here. I'm just going to move ahead. So first, Gary Blitz is with Aon. Maybe Gary, you could give us a brief, discuss your background briefly.
Sure. Thanks, Ellen. Well, first, thanks to Nixon for hosting this today. I'm Gary Blitz. I am one of the co-heads of Aon's M&A and Transaction Solutions practice, which is the group at Aon that does rep and warranty insurance and tax insurance and litigation insurance and other solutions to bring capital and maybe help people achieve more efficient transaction structures. My day job is I'm the global head of our tax insurance practice and a former tax lawyer. I came to Aon about 16 years ago and really got involved in the very early days of insuring tax risk, and have seen this go from back in the days of leasing through all the different tax credits, affordable housing, renewable energy, and it's very exciting to have this a new tax credit to figure out how to insure and enhance the transaction structures with insurance. Thank you.
That's great. Just going across, let's see, Matt, maybe you could
Thanks, Ellen. Great
Great.
to be here. So my name is Matt Lucas. I'm the Managing Director for Business Development at New Energy Risk. New Energy Risk is an insurance company. We're a subsidiary of AXA, which is the $1 trillion French multinational insurer. AXA is the largest property insurer in the world and carries a AA- credit rating. Our mission at New Energy Risk is to enable project financing for new clean tech and low carbon technologies, and that certainly includes carbon capture. We're really bullish on this space, and that's why we're excited to be here. We help enable this by taking the technology risk, and in the case of carbon capture, taking the geology risk off of the back of the project investor. And this is all in the service of trying to bring more capital and more efficient capital to the table. Our pipeline in this sector is nearly $1 billion US, and we're really looking forward to helping grow it. So looking forward to the conversation.
Thank you so much, Matt. Next up is Lindene Patton, who joins us from Washington.
Hi, thanks, Ellen, and thanks to Nixon Peabody for sponsoring this event and setting it up. My name's Lindene Patton. I'm a partner with Earth and Water Law LLC. My primary practice focuses on assisting insurtech and fintech businesses set themselves up in the insurance or insurtech space. My clients include admitted personal lines, commercial lines, and surplus lines businesses. The subject matter today involves insurance for carbon capture and sequestration. On the environmental insurance side, when I worked in the Zurich Insurance Group, I wrote and drafted the very first carbon capture and sequestration policy that was prepared in the industry. I testified in front of Congress in 2009 on the structure and on the recommended structures for addressing environmental risk in this space. And it also was used to bind the first set of CCS insurance projects, or bind coverage to provide environmental liability coverage for the first CCS projects that had environmental risk, and they remain in force today. There are a couple of other companies that offer CCS insurance, but it is a boutique insurance product. And I look forward to having a discussion today about the challenges and the opportunities that are presented with these new tax credits in terms of addressing environmental risk.
Great. Thank you. Jordan, you're up.
Good afternoon, and thank you for having me. My name is Jordan Tamchin, and I lead the tax insurance practice at CAC Specialty, which is an integrated insurance brokerage and structured solutions business. One of our specialty practices is providing M&A solutions for our clients, which includes rep and warranty insurance, contingent risk insurance, and tax insurance. I'm an M&A tax attorney by trade. I started my career at PwC in the M&A tax group in New York. There I advise private equity funds and multinationals on tax due diligence and tax structuring. I then moved to Simpson Thacher, where I represented multinationals and private equity funds on the tax aspects of M&A transactions, joint ventures, spinoffs, and capital market transactions. In 2016, I joined Concord Specialty Risk, which is a leading managing general underwriter for transactional risk insurance, where I led the tax underwriting team, multiple billions of dollars of tax insurance, particularly tax credit insurance for renewable energy projects. In November of 2019, I decided to make the move to the broker side and help launch CAC Specialty's transactional liability practice.
Thank you, Jordan. That's great. And last but not least, my partner Sharif, who has been doing a lot of tax credit deals and will lead that portion of the conversation. Sharif, maybe you want to say a few words.
Yeah, the lawyer doing a lot of tax credit deals. I'm Shariff Barakat. I'm a partner here at Nixon Peabody in Washington, D.C. I started out as a pure tax attorney for a number of years. Now I do more of the corporate and project finance side of things, but I stay very abreast and involved with the tax side as well, and it works out well for these asset classes that are incentivized with tax credits. So really looking forward to our discussion here with this great panel.
Okay, so I think we have a very good panel, and while we'll try to focus questions on individual members of the panel, I do think that, you know, based on our prep calls, there's going to be a lot of back and forth and people jumping in with ideas. So this is going to be, you know, lively discussion. So first off, you know, we've identified on this slide a number of the risks that we see sort of common across carbon capture projects in general. So we'd like to start in general talking about the technology and the performance risk, and, you know, sort of as a separate insurable risk, you know, understanding that there's going to be a lot of situations where one risk kind of, I think the term is clashes. It's a technical term I've learned recently, with another line of insurance that might be provided. So but for now, let's just stay within certain policies. And the first policy is what if any policies are out there when it comes to the technology and the performance of carbon capture projects. And Matt, I think you're the engineer on the panel and probably the best person to address, what is out there, what the concerns are, how insurance companies are looking at this, and how they might dovetail with warranties or indemnities that are available from the manufacturers of the equipment.
Absolutely. Thanks, Ellen. So we're going to talk about a bunch of different risks and perils today, all of which we're going to have to overcome in some way, shape, or form, and we hope insurance can be part of that solution. We're going to start with construction and technology risk performance, which is what New Energy Risk really focuses on. We've underwritten over $1 billion of this insurance for the last couple of years to facilitate over $2.5 billion worth of capital spending, both in the U.S. and around the world. The key challenge here is that if you're going to achieve a non-recourse project financing, your infrastructure finance partners are expecting to see bankable, proven technology with a balance sheet behind it. And for a whole bunch of reasons, that just might not be possible for you. Maybe you're a startup that's developing a new technology that doesn't have a field track record, or you don't have your own balance sheet. Maybe you're an incumbent who is massively scaling up, or you're either of those, but you're trying to apply your technology to a new application. In all of those cases, you might call it credit enhancement, but you need somebody to backstop that the technology is going to work the way you promised and warranted. This is our business. We can think about this in 3 different segments. The first segment is what we call construction risk or builder's risk. This comes before what's termed mechanical completion. And this is basically assuring that the project will be erected as designed and achieve hydraulic and pneumatic completion. The second stage is actually where project finance most commonly defaults, if you look over the data over time, and that's from mechanical completion to substantial completion, or COD. A lot of engineering, procurement, and construction companies have become very gun-shy and risk-averse to providing the so-called EPC wraps or EPC guarantees that would normally take care of this risk. The concern is that your plant, when you turn it on, won't actually commission to the level of performance that you expect. That's a risk that New Energy Risk can underwrite. And then the third horizon is after your commercial operation date and you're into the life of your project in ongoing operations, you want to make sure that your plant's not just going to work on day 1, but on year 1 and year 2 and year 5. And this is particularly relevant for tax equity investors, right? We're talking about 45Q, which is a production tax credit. So if your carbon capture equipment doesn't work and keep working, you might have a challenge there. Again, this is something that technology performance risk insurance can handle. How does this actually work? Basically, we're going to stand between the special purpose company on one hand and your project investor on another, and via our AA- rated insurance policy, promise that project investor that if your project is not producing sufficient free cash flows to meet your capital service obligations, whether that's debt, mezz, or equity, we will step in with our $1 trillion AA- balance sheet and pay that investor on your behalf. But it's critical that this cash flow shortfall has to be due to a technology issue. That's why we're not a financial guarantee, we're a technology performance guarantee. But we found through our $1 billion of insurance and $2.5 billion of capital that have been brought to the table as a result of this, that this sort of insurance is really effective at bringing debt to the table, and that helps reduce your overall cost of capital.
That's really helpful. So what kinds of technology have you backstopped in the past?
All sorts. We've worked in fuel cells, electrochemistry, advanced biofuels, renewable natural gas. But just to show you how far afield we go, we helped support a nuclear fusion reactor in Wisconsin last year that turns Russian high-enriched uranium into molybdenum-99, which is a radiopharmaceutical that is used in PET scans. So I'm pretty sure that if we can get our heads around nuclear fusion, we're well equipped to handle carbon capture.
I hope so. That's really impressive. I just one more follow-up question. The underwriting process for something like a carbon capture facility, what's the timeline? Is that something that would take your insurer or others, a lot of time to get their arms around?
Yeah, great question. It depends on the size of the project in dollars, but typically 3 to 5 months from start to finish, which you'll recognize is much shorter than the time it would take you to, say, run a public bond offering if you were to raise debt. We've never been the slow man to reach financial close.
Okay. There's a couple of questions coming in, but I think I'm going to save those for the end, the last 20 minutes of this presentation we're going to have for Q&A. One of the things, and again, Matt, I'm sorry, I'm going to just go back to you. The so-called cliff that I keep gravitating to is I think it makes the performance risk that much more critical. And maybe this is the tax insurance aspect of it, since if you don't produce a certain amount of emissions on the one hand and sequestration on the other, capture on the other, you can fall over the cliff in any given tax year over the 12-year period, credit period. Is there anything from a performance risk insurance perspective that might support the unique risk associated with the cliff?
Yeah, so we're absolutely prepared to handle that. Most of the projects, all the projects we're looking at, are significantly larger than the cliffs, and so for them to approach the cliff would require a very, very significant underperformance. But you could imagine that if you're 1 ton short of CO2, based on what you thought you were going to do, we can pay you that increment. You'd imagine that at some point you get below the cliff, and every increment, it sort of doesn't matter how many less than base case you are, because you've fallen off this cliff and you've lost all your 45Q. So we would schedule that into the formula for the insurance payout.
Okay,
but
great.
It's certainly something I hope that we'll all be commenting to the IRS about.
Yeah, I think it's definitely something that we're thinking about and our clients are thinking about. So another category of risk that we see in most project finance deals in general, but particularly in the deals here where you're sticking carbon into the ground for long periods of time, are environmental risks. There could be damages as a result of a leakage. There could be some sort of natural resource damage. And I guess leaving aside capture as a tax matter, under the low carbon fuel credit in California. I know, Lindene, this is what you've been doing and you have done, and maybe you could talk about the kinds of policies that are out there and how you think that they might be adapted going forward for projects in the CCS space. You're on mute.
See, there I was, being good, being on mute, but now I can talk. So thank you. And yes, I have designed these products before, and they're actually in play in active CCS projects, typically involving chemical facilities now in the Midwest and other locations. And there are other large entities that have put these structured programs related to this that include environment in other parts of the world. But generally, environmental insurance is a specialty coverage. The kinds of risks that you'd be concerned about when it comes to geological storage from a pollution event would include potential bodily injury, although in the case of CO2, it's a little difficult. It just depends on what that CO2 causes to move. So, for example, if it happens to get into or another resource extractable and move that extractable in an unpredictable way into, let's say, a groundwater source. You can have both property damage that would come from that pollution, potentially some bodily injury, but you could have property damage that can be caused to another extractable resource that you really need to think about. That is typically not the kind of property damage that when you write environmental liability coverage you're thinking about. And you had mentioned natural resource damage. There's, of course, that potential risk. And the complexity that you have that is unique for CCS, you don't tend to have in other environmental insurance facility coverages, is that this facility is below the ground. You can't see it. The testing to verify its functionality is typically seismic. Although there are discussions now about mass balance, that underwriters that I've spoken to are not particularly comfortable with a mass balance approach in terms of doing verification to address the casualty risk and the specialty environmental risk. So I think that's going to have to get worked on. In addition, the form that I had worked on included some level of business interruption coverage that wasn't otherwise focused on the tax credits, because there are obviously, when facilities stop working or there's a challenge, there are other business interruption coverages that tend to present. Control of well is a unique coverage which is offered under these environmental policies. So for those of you who do not typically travel or traffic in the energy space, it is unfortunately an occasional occurrence, and they tend to be catastrophic, that due to the pressurization of the well, you can have a failure of the well. And unlike what you think about a failure of a well, you'd think, oh, it would just stop working. Well, everything tends to come back out. And so if you have a catastrophic well failure, you need to have engineering solutions in place to cap that well, capture as much as you can in the retained amount, but there are consequences from that release. Now, in this case, it's unclear whether it will be site unique, whether there would be a coverage that would be triggered under the environmental liability policy. In other words, did it cause bodily injury, property damage, or natural resource damage as calculated, or is it merely going to be a loss of a tax credit that is otherwise picked up under another coverage? That, I think, is a discussion on a site-by-site basis. And there are risks associated with transmission of these materials, so unintended traveling into locations where you outside of the intended storage location. You got to figure out what you're going to do about that liability issue. You have to buy other people's property. And the final risk, which presents itself in this type of storage space geologically, is a geotechnical risk. It's basically a seismic risk. And there have already been occurrences of earthquakes that are man-induced earthquakes that have occurred from overpressurization of geologic storage. And the consequences that can present from that can be significant property damage outside of the storage space. And so the coverages that I have drafted have included some sublimit for seismic coverage. But I think the most important, really, there are probably a couple of really critical things to communicate in this discussion about the role of environmental insurance as contrasted with, let's say, a technology guarantee. Or with what we usually call a specialty coverage. The capacity in the market is far lower than in the environmental insurance market than when you talk about in the financial insurance market. So if you look at, I don't care whether you look at reports from Aon, you look at reports from Willis or RT Specialty or anybody who does market reports, 2019, 2020 presented capacity in the market $2 billion, okay, as far as the $2 billion premium throughput. but the capacity of limits available to date, which includes all lines of environmental insurance from E&O to facility, is $800 million. All right, that on a project basis, given the size of the project that you're talking about here, might sound not small enough. But I think in structuring these projects, everybody needs to take a step back and realize that the limits that are necessary to address the potential bodily injury, property damage, and natural resource damages that are environmental in character are different than your tax credit. And so I think that it can be possible, and we can have a discussion about this in the Q&A a little bit more. It's absolutely possible to address and create a rational environmental liability product here that can be meaningful in the transaction, but you need to manage expectations up front, because if everyone expects the limits to match the tax credit limits, you're not going to get to yes. And the second thing is that the tenor of these projects, so the time appetite for underwriters in the environmental space is consistently, they love 1 year, they will choke, scream, cry, and maybe give you 3 to 5 years. But right now in this marketplace, finding anybody, even on a transactional basis, that will go beyond 5 years in the environmental space is difficult, if not impossible to do. So I think that everybody needs to manage the expectation about those limits, and you need to manage your expectation about tenor. A final comment I'm going to make about the tenor issue is I think people need to not worry so much about that tenor, because all matter of operational coverages in the property and casualty space are renewed regularly on an annual basis. This is nothing different than anything else. And I think to date, unfortunately, whether you're talking about 2009 or now a decade later, some of the fear has been the potential for non-renewing of these policies. And that really hasn't necessarily been an issue at all in any of the existing CCS projects that are insured today. It's just they're very small in number. And so I think that there needs to be much more collaboration amongst the insurance market and amongst the transactional structuring, the lawyers who are structuring the transactions, to try to make sure that you get to yes and you get a positive solution. So I'll stop there with my comments on the environmental project itself, and then if people have questions in the Q&A, I'm happy to go deeper in each one of those issues.
Yeah, Lindene, thank you so much. That was great. Question for Matt, maybe just very briefly. What's the process to getting a permit to actually do these injections? I know there's class 2 permits and there's class 6 permits. So maybe just focus on the class 6 permits right now, because that's the non-EOR solution. And what does it take? And I'm assuming that all the insurance that we're talking about and any project that's going to have a geologic storage aspect is going to have to be able to get that permit, provide long-term credit, financial support to backstop that, and to be able to operate in absolute compliance with the requirements of that permit.
Right, thanks, Ellen. So a Class 6 permit, for those on the call who aren't familiar, is a part of the U.S. Environmental Protection Agency's Underground Injection Control, UIC program. It's meant to safeguard drinking water so we don't leak things like supercritical CO2 into our drinking water reservoirs, aquifers. That's a multi-year process, and I think the biggest concern here is that very few Class 6 permits have been applied for and granted to date. So there's just this sort of regulatory uncertainty about how difficult and what the timelines will be. We use as an insurer the Class 6 permitting process as part of our underwriting. So Lindene mentioned about how a lot of underwriters aren't comfortable with the simpler mass flow approaches. I think we're certainly in that camp. We like the stricter Class 6 subpart RR reporting paradigm. The key thing here is that if you're thinking about developing a very large-scale CCS project, you're going to have a bunch of permits that you're going to have to get, and those include your UIC permit. So you're going to start early. You're going to use dev capital for that, and you're going to want to start that conversation with New Energy Risk or Lindene so that we are part of that conversation early, right? We're already talking to California's Air Resources Board and EPA about what they're going to require, because ultimately, at the end of the day, this is about satisfying the regulator.
Okay, great. So we've got a lot to cover. I'm just going to quickly talk about, are there any policies that anybody on this panel is aware of that might cover the credit risks of the emitters or the off-takers, given that there's going to be a lot of presumably indemnification obligations that are, undertaken by those entities. There's, per the proposed regulations, the off-takers have to, contractually ensure the sequestration, and there's obviously going to be some indemnities. There's going to be some minimum amounts of from the emitter side that might be supported by some sort of a liquidated damage provision. Is any of that something that insurance can cover or backstop?
Ellen, if you want me to jump in on that, can I? But before that, I just wanted to comment on something Lindene said a couple minutes ago. You shifted to Matt quickly. In terms of limits and policy term, I think we see there's lots of different silos and different buckets of capacity in our industry, and in the transactional liability world, which is where tax insurance sits, there's a lot of capacity per transaction, north of $1 billion, and the ability to go out, with multi-year policies, 7 years, 10 years. We just did a $700 million program for wind production tax credits that went for 10 years. So it's not necessarily one size fits all, and I think when we talk about these different types of insurance products today, many of them are really aimed at the project and the developer and protecting the longevity of the project, and indirectly the tax equity and the investors. When we talk about tax insurance, the vantage point there is really the tax equity. And it's that extra slug of money coming in to get at the tax credits and really provide that development capital. And whether things make sense or not, I think tax equity comes to these projects with a very high bar. And even though policies can be renewed, and I agree, logic would have it that we should be selling one-year tax policies and they can renew every year. But the reality is I've never met a tax equity investor that wants that. They want to know they're covered for the long term to match their investment horizon. So that, that's something we contend with all the time. And some of the insurance involved gets renewed year after year, and some of it gets put in place at the very beginning for a long-term period of time. On the credit side, a lot of the things you just mentioned really can be supported by the very traditional surety products that are out there. But surety is not really risk transfer. It's a front for another company's balance sheet to protect the counterparty, and getting those surety products put in place requires a creditworthy company or developer to stand behind them. So that's a lot of what it's going to get down to. And the reason tax insurance has become so popular in the renewable energy area, everything we do with tax insurance could be done as a credit enhancement of the developer's guarantee or the developer's indemnities. But the developers don't tend to be creditworthy enough to get those policies at a cost-effective price. So what we're able to do with tax insurance is, since they're fundamentally tax risks, it just so happens the developers also often indemnify for them. We were able to insure them with a different product and protect the tax equity and get to the right result, even though it's not formally a financial guarantee or a credit enhancement.
Okay, well, that's really helpful. I mean,
Can I make one other comment about that? I think, it may be that Matt has a comment to make about this. Don't forget that if you're going to do a Class 6 well, there will be a financial responsibility requirement that must be satisfied. Typically, those are written as separate policies, financial assurance, separate from the environmental liability structure itself. It will have specified limits, which are defined by the permit itself. So the permit will reflect what the financial assurance requirements are. The policies are structured so that in the event that the holder of the permit, so typically the operator, becomes financially unable to meet their obligations under the permit, that the regulator can actually step in and either directly perform the work or take other actions to terminate the permit. But I think that there's a long history in the environmental insurance space writing financial assurance products for things like dumps, waste dumps, whether they're your trash dump or whether they're hazardous waste dumps. So the structures exist. They're well-worn, well-used, well-known to deal with big, ugly, scary facilities like hazardous waste dumps and hazardous waste treatment facilities. And there is a lot of history about how you work around managing the credit risk that is embedded in that financial assurance in order to make transactions go. And a lot of the tools that have been talked about here are used, but it's usually not a pure indemnity. It is a balance sheet issue. It is not a surety, but it's pretty darn close in the way that the function of the product works. So you can't think about it as an indemnity product, and it's not underwritten that way in a lot of ways. But it is a financial transactional agreement between the insurer and the insured who has to post that financial assurance, and there are very unique characteristics to it. So that will manage some of the credit risk that is of concern, I think, to some of the people who are on the call. And I don't know if Matt has a comment about that in terms of how they're called for these statistics. But
yeah, so, we're definitely looking at how to use insurance to reduce the financial burden of that Class 6 UIC financial insurance. And Dean was mentioning, just to put some numbers around this, if you're doing an ethanol plant carbon capture retrofit, your capture equipment might be $10 to $20 million, but to fully fund a trust, which is sort of the most brute force way to meet EPA's requirement, might be $40 to $60 million, right? Like several multiples of what your capture project would cost. And so you can imagine that if you can use insurance to bring that, make that financial assurance cheaper, you might, relative to a fully funded trust.
Okay. I'm just going to cut you off there, Matt. I mean, this has been amazingly interesting, but I think we also want to pivot to the tax insurance side of things, and I'm going to let Shariff take a crack at leading that part of the discussion.
Thanks, Ellen. Well, I think the conversation we just had nicely does start to set the stage for a bit of where we wanted to focus on with some of the tax risks and how tax insurance can solve those. And Gary, you started to set it up, but Jordan, I think it'd be helpful for the listeners if you could just kind of give a relatively quick overview of kind of what is tax insurance right now. What does it look like for the renewables transactions that have attracted tax equity?
Sure. Thanks, Shariff. So for those who are not familiar, tax insurance is designed to protect our clients against a tax loss arising from a taxing authority's challenge to a tax position. So this allows our clients to execute the underlying transaction or investment with complete tax certainty. It provides them with a level of comfort similar to a private letter ruling. Effectively, tax insurance is a risk management tool allowing the taxpayer to allocate the economic risk of a tax loss to the insurance market. Tax insurance is designed to make our client completely whole in the event of a challenge to a tax position, and therefore can cover additional taxes, interest and penalties on those taxes, contest costs, which is the cost to defend a taxing authority's challenge, and gross up, which are the taxes incurred by the insured upon the receipt of the insured's proceeds. So let's explore how tax insurance can be used to protect tax equity investors. So to start, tax credits can be used to reduce on a dollar-for-dollar basis a taxpayer's income tax liability, and therefore tax credits are used by governments to incentivize investment in social or environmental initiatives such as carbon capture and sequestration. As many of you know, there are generally two primary parties involved in a typical tax equity transaction. The first is the sponsor of the project, who's the party responsible for getting the project funded. And the second is the tax equity investor, who's the party that will invest in the underlying project in exchange for the tax credit and other cash flows expected to be derived from the project. As part of the finance transaction, the sponsor generally indemnifies the tax equity investor for any loss of the tax credits that are expected to be generated from the underlying project. In the context of tax credits, like the Section 45Q credit, the primary use of tax credit insurance is to protect a tax equity investor against the tax loss arising from its investment in the underlying project, here a CCS project. Like I said, at the end of the day, tax equity invests in the underlying project in order to receive the anticipated tax credits and other tax benefits. As Gary touched on, historically, particularly as it related to renewable energy tax credits, tax credit insurance was generally used by tax equity investors as a means to get sign-off from its credit committee in order to execute the underlying transaction. There was almost less of a concern about the actual tax risk and more of a concern about the creditworthiness of the counterparty. The insured under the policy was typically the tax equity investor, and in order for a loss to be triggered under the policy, not only did the taxing authority have to successfully challenge the tax credit, but the sponsor had to fail to make good on its indemnity obligation. Thus, the insurance acted as a credit enhancement to the sponsor's balance sheet. However, as the market matured and got more comfortable with the underlying risk transfer, the insured under the policy switched to be the sponsor, who typically has an indemnity obligation to the tax equity investor for any loss of the anticipated tax credits. So if the taxing authority successfully challenged the tax credit, the insurance would respond first dollar subject to any retention. In this case, tax insurance protected the balance sheet of the sponsor by providing liquidity to pay its indemnity obligation to the tax equity investor. The last thing I just want to mention is that there are three general tax risks that our clients seek to insure in tax equity transactions. The first risk deals with the structure risk, and the question here is, will the investment structure be respected? For example, will the partnership flip structure be respected? In fact, in the context of Section 45Q credits in Rev Proc 2020-12, the IRS identifies tax insurance as the preferred means to protect the tax equity investor against the structure risk. The second risk deals with the qualification risk and is by far the most common risk insured by our clients. The question here is, will the tax credits claim be allowed in full? Historically, the most common issues insured by our clients include the basis risk for solar property and the begun construction risk and the 80-20 rule for wind property, and to a lesser extent, the placed in service risk. I would expect the begun construction risk and the 80-20 rule to be ripe for insurance in the context of Section 45Q credits. Last, the third risk deals with the recapture risk, and the question here is, will the tax credits be recaptured even if properly taken? Again, in the context of Section 45Q credits, Rev Proc 2020-12 specifically provides that taxpayers may seek tax credit insurance for the recapture risk. Insurance for the recapture risk is probably the most important topic to tax equity investors in the context of Section 45Q credits. And as we'll discuss, the Section 45Q credit is likely going to be the next iteration of tax credit insurance.
Thanks, Jordan. Great overview. And I think one of the things you mentioned there, kind of going through the evolution of it, just so people picked up on it, was that shift in the tax credit insurance world that Gary mentioned as well, of moving from I can't remember exactly the insurance people's terminology, but wrapping the credit of the sponsor to actually being a true risk transfer, right, where the payee is directly the tax equity investor. And so I think, Jordan, you kind of mentioned a few of the things, right? We got the structure risk that's currently getting insured a lot. We have begun construction, tax credit qualification risk getting insured a lot. Recapture risk is going to be a risk, at least on carbon capture. It is on solar, not on wind necessarily. But Gary, I guess turning to you, where do you, what of the risks that are do you kind of see that perfectly translating over from the current tax credit insurance, we're going to see that exact same set of risks get insured, or are some of those going to be harder for carbon capture than they were for solar or wind?
Yeah, I think it's going to be a progression. The kind of fundamentally the structure of the sorts of risks that can be insured, and Jordan did a nice job, going over them. The structure, qualifying for the credit and recapture, is going to be the focus. But Jordan mentioned how we saw on solar basis policies them kind of switch over for the most part from double trigger, where the original insurance policies required both a successful IRS challenge and a failure of a developer to live up to their indemnity. We still see that, and that works when it's one particular risk or it's a legal risk. That we still see the double trigger more where we're focused on recapture, or at least there's a right to subrogate to the developer. And in the 45Q space, I see a very similar progression. I think the early policies will be very much broad-based, covering, if not structure, because sometimes we see that, but that's not typically indemnified by a developer, certainly the qualification and recapture. And in the early policies, those will be double trigger, and they will be very dependent upon strong traditional insurance programs, and I think technology programs like Matt underwrites being there at the project level. So the tax insurers who are there to benefit really tax equity, not the project, want to know that there's a secure project and a properly insured project underlying the tax insurance. And with that, I think we'll see the tax insurers at first doing this on a double trigger basis. And maybe over time that evolves. The two big challenges I see here in the technology risk is certainly one of them, but two in addition to that, the time periods are going to be a real challenge. I mean, these policies, I think, really could need to go out to 15, 20 years. I think it's a 14-year period plus perhaps statutes of limitations. That will stress the market. We have an ability to do that. We see policy terms like that with affordable housing, with the low-income housing tax credit, but the whole market cannot do that. And also the limits. I think the CCS projects can be extraordinarily large and require a great deal of tax equity. And right now we can do probably north of $1 billion on any one transaction, but as we require longer policy periods, that number gets challenged. So I think this will be a progression, and just like we saw with other tax credits a year ago or a year and a half ago, doing 10-year policies on PTCs was a challenge. Today there's capacity to do it. So the insurers will also step up and do what they need to do with this demand, because I think they've always found the tax credits to be very good business. And if we need longer policies or more capacity, I expect the insurance market to step up to it.
Let me ask you a question kind of on what you were just saying there. So is on the recapture piece, because I think a lot of the people who are watching, they know kind of what the structure policy would look like, insuring against IRS audit there, the begun construction even, right? It's a legal analysis up front. The technologies might be different. What steps people take might be different, but the process there is a known quantity. I think I get the sense probably to the extent there's been recapture insurance on solar, it may not have been given, as much thought, given the kind of the logistics and the operating risk of solar compared to at least carbon capture. So on the carbon capture side, I guess, I know you were saying you'll probably expect to see double trigger kind of coming out the gate. I mean, and also you expect to see a well-insured project itself, aside from the tax issues. But the quick question that jumped to my mind is, assuming all that's in place, will the tax insurance then step in for a true operational risk at that point for that recapture, or will it kind of require all the other avenues to get exhausted first and maybe not even cover it at all?
No, it's a really good question, and I think it's very analogous to our experience with solar. And there, I agree. It's the technology is much simpler, but one of the triggers for recapture with solar is a total property loss, wiping out the solar facility. And the tax insurers, you'd ask any one of them, they're not in the business of writing property insurance. There's a very well-developed insurance market that does that, and they do that with relatively annual, maybe 2-year policies that renew. But tax equity sitting there by the side saying, I don't really want to know that that's going to be renewed every year. I want to know that I'm covered for recapture because I'm thinking about it as credit enhancing the developer's obligation. And it's, I think, going to be fundamental to the tax insurers. I think they will step up and do that, but it's going to be fundamental to them to know that that underlying performance risk and the traditional part of the insurance program, or maybe traditional is not the right word in this context, but that other type of insurance is there underlying the project, and tax insurance will wrap around it. But I think it's exactly analogous to what we've seen with solar. It's just a different type of risk.
Hey, Shariff, could I just quickly comment on the policy period point? So as Gary was mentioning, I think generally the longest policy period is 10 years for which there's significant capacity in the insurance market. But despite the potential for a 17-year recapture period in the context of tax equity transactions, I think if the tax insurance is placed with a tax equity investor, so we're insuring the investor and the developer, I'm not sure if a 10-year policy period would be problematic from a tax insurance perspective, since it's my understanding that most tax equity investors have no intention to stay invested in a CCS project during the entire 12-year credit period and are generally limited to a 10-year investment period anyway. So if that is the case, I think there may be sufficient capacity in the insurance market to insure the initial tax equity investor for a 10-year policy against any of the risks, particularly the recapture risk. And as it relates, I guess, to recapture as well, I do eventually see that recapture being another insurable risk. It's historically been insured, like we've been discussing in the context of Section 48. However, the recapture process under Section 45Q is definitely more complicated compared to the application of recapture for ITCs. But again, the RevProc approves the use of tax insurance to mitigate the tax credit recapture risk. But, regardless of whether the CO is going to be disposed of through sequestration or used as a tertiary injected for EOR projects, the recapture risk for CCS projects will likely be insurable by the tax insurance market. And given the overlap with the environmental risk due to CO leakage, I do foresee tax insurance underwriters potentially working closely with their environmental counterparts to underwrite this recapture risk. I think Treasury has provided pretty clear rules in the proposed regs on its standards for establishing secure geological storage that will be helpful to get the insurance market comfortable with the recapture risk. I mean, in the case of, CO disposed of in a geological storage and not used as a tertiary injected for EOR, I think the insurance market's going to want to take a look at and underwrite that EPA approval for an MRV plan, which is going to provide for monitoring, reporting, and verification of the amount of CO sequestered. And as it relates for CO used as a tertiary injectant in the EOR, the proposed regs provide for either use of subpart RR or the alternative ISO standard. But like subpart RR that has that EPA approved MRV plan, the ISO standard also includes the requirements for annual reporting, record keeping, monitoring, and leak prevention, which will help the insurance market get comfortable with the recapture risk. And I think, even more important, in the case where there's an owner of the carbon capture equipment that enters into a contractual arrangement with either a third-party storage provider or a CO off-taker, that third party will generally provide representations and covenants regarding the adequacy of the disposal of the CO. And in some regards, I think the ability to get the insurance market comfortable with the recapture risk may be a little easier if that capturing party is being indemnified by a third party who's responsible for the geological storage of the CO. And this is really going back for the two reasons that we really discussed before. First, the tax insurance will act as, a credit enhancement to the third party's indemnification obligation. So the insurance market will only pay loss if, one, there is a tax credit recapture, and then two, the off-taker failed to make good on its indemnity obligation. And then second, the taxpayer will likely undertake its own robust due diligence of the off-taker's policies and procedures regarding the storage of CO to avoid any leakage. And as part of underwriting, the insurers can then piggyback off their due diligence findings. And this isn't too dissimilar from the due diligence undertaken by buyers in an M&A transaction that's relied upon by insurers for rep and warranty insurance.
So kind of, it sounds like coming back to that double trigger type standard place that Gary was talking about, starting there and a few ways how to get comfortable. One other thing, Jordan, I know you've thought a lot about is the sizing, just the way the recapture mechanics work and the fact that parties can come in and out. I'd love to hear from both you, and maybe you could tee it off because I know you've thought about it, and then hear Gary's reactions. Just, if you have a different investor in the year that kind of claimed the credit, and then it's really offsetting credits being generated 5 years later, or 2, 3, 4, 5 years later, that should be inuring to the benefit of a new investor. What are you thinking about how those, how would you structure a policy to address that?
Yeah, so I did give it some thought. I thought I had the answer, and then I realized I didn't. But as it relates to sizing, if you're solely insuring the recapture risk, the taxpayer, along with its tax broker and tax advisor, will want to consider how much tax insurance to purchase in the event of a recapture. Given the 5-year look-back period, the uncertainty as to when and how many leakages may actually occur, and the magnitude of such leakages, my initial reaction from a conservative perspective is really just to ensure the total amount of estimated tax credits over the entire investment period. While this amount may seem excessive, there really is no good way to calculate the potential exposure to the recapture risk. At the end of the day, the amount of limits purchased will, the amount of limits purchased to ensure the recapture risk will have to be a judgment call by the tax equity investor.
Have you thought about that, Gary? Kind of what would you recommend on limits and how to think through structuring the, I don't know if you'd say who's insured, who's taking the loss, who should take the loss?
Yeah, and a few things there. I find, sometimes the best answer that doesn't always prevail. And I find, again, going back to who our constituent is, which is tax equity, they often like their own policy. So even though we have a great solution covering everybody under one, that doesn't always carry the day with them. But I think for the issue you raised really can borrow from the low-income housing tax credit world. I mean, there too, you can have investors in and out of projects. And what's happened, it's kind of the reverse there. What happens in the future could impact credits claimed by someone who's no longer in the project. And we've been able to deal with that. I obviously have that going on right now. And I think this is just the flip side of that. So it's a matter of isolating your thinking to who your particular insured is and figuring out what is their exposure to not getting the credits they're anticipating getting, either because they didn't qualify for them or they can be clawed back. Sizing it off of that, and then to add complexity to it, you have to evaluate whether you need to add something for interest and penalties and maybe cost of defense. And then your policy proceeds will be taxable, so have to evaluate whether you want to add in a gross up. And that's another place we see very different approaches by different clients. Some clients want that most extreme amount of coverage, so tax plus interest plus penalties plus a gross up. And then other clients take a more practical view and buy less insurance covering all those elements, but subject to a smaller limit, so they spend less. And it's a very individual decision that way.
That's helpful. I know we want to get to a Q&A here, so I don't want to take too much more time, but one question I thought I'd throw out to the two of you, and really Lindene and Matt as well. I know you've been listening here, and is there anything that you think the IRS, Treasury could put forth, something that you're hearing chatter about now? Obviously, they could put regs out and solve every issue, right, theoretically, but something that you think would help the insurance industry maybe even get more comfortable writing policies. As Jordan mentioned, insurance is suggested for tax equity as a risk mitigant for tax equity in some of the revenue procedures the IRS has for tax equity deals. But is there any kind of top of mind issue that you guys think, once the IRS addresses it, either I'll be able to insure it, or I definitely won't be able to insure it, or maybe people won't want it to be insured?
I mean, my starting point is I'm ecstatic when the IRS puts in a safe harbor that tax insurance should be used to cover recapture. So I'm good with them. But anything that can be done to shorten the time periods or impose limits on that exposure is always helpful.
Yeah, I think from the environmental insurance side, obviously, if you can cap any of the exposure, you'll get more participation from the market because you'll be able to do your actuarial, analysis with some more certainty because you can control your tail. The other potential solution is to control the jurisdiction. So a lot of the challenge that you have in the environmental space, and this will never happen, so I want to just say that up front, that if there was a dispute, if you could, pull it to federal court, wouldn't that be awesome? Because the inconsistency in the locations where these projects are present and the geologic storage areas will have a very variable response. So, for example, there are certain jurisdictions in the country where if you look at the real estate plots, the way that, the land is divided up, you find that the state owns a square of land and then private property owns a square of land, and the state and private property. So it's this crazy checkerboard that you have in a couple of states. Those of you who've done underwriting in this are probably smiling and laughing. You know exactly which states those are. And there are other states where the law that applies to groundwater contamination is significantly different than you might have in the West versus what you have in the Midwest or the East. And so again, it's more an issue of capacity generation. So the more complex it is for the environmental underwriter to try to get a handle on what the risks are for a particular site, or the worse the law is for managing and coming to a resolution for environmental damage, the harder it is to underwrite the environmental coverage. So
I'm going to hop in here. This has been a really good discussion. I open, I'm not exactly sure how this works, but I think there's a Q&A bar, and you are all welcome to pepper the panel with questions. We have a couple that have come in over the course of time. I guess one is, who are the actual companies that provide these different policies? I guess maybe we talk about environmental, and then maybe the performance, and then the next bucket would be the tax credit type policies.
Yeah, so Zurich clearly continues to offer the CCS coverage in multiple jurisdictions, not just the United States. Beasley had been offering this coverage for a period of time. I'm not clear whether they still do it, because I tried to do a record research and make a few phone calls and didn't run across some capacity for that. AIG used to, but they're out of the market. So I think this may be a make and create opportunity to work with a couple of underwriters in that process. And this may come down to a situation where there needs to be negotiations with a specialty MGA to adopt this if for some reason one of the few existing markets that underwrite this are not willing to cover a particular project that you want to present. So it might be a little bit more negotiation and drafting that happens outside of the market in order to get, let's say, someone to come up and sign on to a slip. You might have to write your own policy and get them to sign on to a slip out of London or something like that. But doable. I think it's doable. It's just you got to be measured about it.
On the technology side for new energy risk, everything we do is on AXA paper, carries that AA- credit rating. The same would be true for any of the geology risks, whether that's related to 45Q recapture in tandem with the tax insurance. We didn't really touch on the low carbon fuel standard, but it presents a similar risk, or for the financial assurance. We almost certainly be on AXA.
On the tax insurance front, Gary or Jordan?
Yeah, the market's really grown. So there's over 10 insurers, but it's a collection of household name insurers like Lloyd's of London, AIG, Berkshire Hathaway, and and so on. So it's those kind of companies, all A-rated or better, and names people would know.
Yeah, I mean, just to piggyback off what you're saying, that there is a competitive market for tax insurance right now. I do think that are going to emerge in the space to write this type of risk transfer, and others will probably be providing excess capacity to start. And as they get more comfortable with the risk, they may emerge to start writing primary.
Okay. Is anybody writing any insurance backstopping the utilization life cycle analysis that is a third leg of the 45Q statute? No.
I think we had actually talked about this a little bit in our pre-call, though, and when we had thought about, if this question would come up, like, does it kind of fit into like a change of law bucket, or is there some other kind of bucket? I remember, Lindene, you had some thoughts on it.
So in terms of trying to, if you're going to try to structure a bespoke solution for this, again, I just think you're going to have to write the terms yourself and then go out and do a deal. But I think that some of these policies and the risks that people are asking about for the qualification, you need to step back and think about whether that is really more like an environmental risk or is it like a financial risk. And then the answer to that question is going to determine which market you seek assistance from, I think, overall.
Okay. So there's a lot of compliance and perhaps in the underwriting process, an understanding as to who's doing the actual sequestration, which is probably a different company from the entity that's actually capturing the carbon. And then, in terms of the actual physical, the well field or geologic formation, the location that is where there's the injection, what the plume is supposed to look like, and how far it's supposed to spread. This is very technical, and how much of all of that goes into underwriting, and maybe we'll flip it to the tax side. On the tax side for the recapture, that's not your typical analysis for, the tax credit community, but you would think that those, that kind of an underwriting is going to be necessary for, ensuring that things are properly monitored, measured, operated, and, there's a lower chance of a recapture in maybe one sort of region versus another.
I think that all goes exactly back to, why I think we'll start off with double trigger policies. And I don't expect the tax insurance market right off the bat to become expert in all the technical issues. I think they will really ride on the back, so to speak, of the traditional insurers and the developers' obligations. But yes, over time, they'll become more familiar and will learn where the risks are better and worse. And that'll, if nothing else, be reflected in pricing and their willingness to write the tax policy.
So I was going to offer that in 2008, I wrote an article with an economist in the World Climate Change Review that looked at distribution of losses from reservoirs and identified how that would impact the underwriting process, or how it could impact the underwriting process. So this has been thought through before, where the sort of the intersection of the physical reality and the insurance products present themselves. And ultimately, the interesting thing is, as long as the reservoir isn't overpressurized, and maybe Matt has a comment on this, as time moves forward, there are certain chemical processes which occur at the edge of the reservoir, which actually seal it. So the longer you go, as long as you don't overpressurize, the better off you are, which sounds odd, right? It's the opposite experience that we have with hazardous treatment and storage facilities. But as long as your highest risk is typically not your first injection, but all the injection space that you take until that initial set of chemical reactions occur that operate to do it, kind of a geologic seal.
That's really, really interesting. I've heard that as well. So I have a question. I guess there's this might address some of the other questions as well. The 50 PAYGO, how does that get factored into the tax insurance or the other policies, where there are probably other participants in the structure, maybe a bridge lender of sorts that's, looking to monetize not the first 50%, but the balance based on some P99 or P90 type of a forecast for what the project's capability is. Is tax insurance available to backstop the bridge lenders' support for what will be or what people expect to be the PAYGO portion of the tax insurance?
You want me to take that?
Sure.
And we see this all the time. I think, if you think about it, there's a fundamental risk that the tax insurers are insuring, that the tax credit will show up. How it's woven into the transaction, a PAYGO structure is essentially like a holdback. And so, and if a lender's financing against it, it's just almost a matter of who the insured party is. And we can insure tax equity. We can insure the developer behind an indemnity that they're giving. If it's a PAYGO, the tax equity is not going to be as concerned because they're not putting in their money until they know they have the credit. But in that case, the risk shifts to the developer who's not getting the money. And so in that case, the policy should be protecting the developer. If there's a bridge lender that's ultimately funding it, the policies, and we often do this with solar now, we'll name the lender as a loss payee because, indirectly that's where the proceeds need to go, and they want to know they're going directly there and not passing through someone else's bank accounts.
Mm-hmm. I don't think we really hit this one specifically on the head earlier, but, the economic substance component, is that something that anybody would like to speak to?
Yeah, I'm happy to speak to that. So, taking a step back, as it was initially discussed, the Section 45Q credit provides a tax credit for capturing and sequestering CO in the amount of $35 per ton for projects sequestering the CO in an EOR project or through utilization project, and $50 per ton for CO sequestered in secure geological storage, not as part of an EOR project. And given the magnitude of the credit, these congressionally authorized tax benefits will likely exceed the income generated by a CCS project, particularly for CCS projects that do not generate any revenue. Thus, a concern with respect to CCS projects is that certain projects may not generate any cash return and that tax credits may constitute the sole economic return for the project. And because the economics of CCS projects will rely heavily on the tax credits, a tax equity transaction arguably may lack economic substance under Section 7701. And at a high level, the economic substance doctrine holds that a transaction structured solely to take advantage of tax benefits will not be respected for tax purposes. As such, many taxpayers have urged the IRS to directly address this issue about economic substance doctrine in providing guidance on partnership structures for the Section 45Q tax credit. The IRS has historically been unwilling to take on this economic substance doctrine directly in the case of tax credits, and this is true in the current guidance provided by the IRS in Rev Proc 2020-12. For those who aren't familiar, Rev Proc 2020-12 provides a safe harbor under which an investor will be respected as a partner in a partnership that owns the carbon capture equipment and thus will be entitled to an allocation of the available Section 45Q credits. While the IRS failed to address the economic substance issue directly, it's my view that the IRS's reference to certain authorities on bona fide partnerships, as well as addressing the allocation of the Section 45Q credit if a project company does not receive payments from its sequestration activities, is its way of giving some level of comfort on economic substance without addressing it directly. It's also my view that the legislative history to the codification of the economic substance doctrine, as well as case law, supports the position that the doctrine should not apply to disallow any tax benefits associated with a CCS project. Specifically, the courts have found that economic substance doctrine should not apply because the taxpayer is claiming congressionally authorized tax benefits in the manner intended by Congress. So for these reasons, I do think that the insurance market will be comfortable with ensuring the question of whether the economic substance doctrine would apply, particularly to disallow any of the tax benefits associated with a CCS project. I think one thing to mention, though, that as in the case for other types of tax credits, since the investor must assume the structure risk associated with the transaction, but is otherwise permitted to insure that risk, it's generally understood that the investor must obtain the insurance and then that it cannot be provided by the developer. Otherwise, the insurance would be akin to an impermissible guarantee.
Wow, that was awesome. So there are a lot of follow-up questions. Unfortunately, we have now blown through the full hour and a half. I encourage people that have follow-up questions to reach out to our panelists, to myself and Sharif, and especially if there's anything that you think needs, to be commented on within the next week or so for the most recent set of regs, please reach out to us or just make those comments so that we can try to get, the statute in as good a form as possible. And thank you guys all for dialing in, and we look forward to having conversations about CCS and 45Q with you in the future. Take care.
Thank you.
Thanks.